Good afternoon and welcome to part one of the March FOMC meeting. Very briefly, what we're going to be doing in today's FOMC meeting is we're going to start off and we're going to have a brief little overview of the Fed. So what the current stance is, what the current thought is going into tomorrow's meeting. We're then going to discuss the meeting format in terms of times, in terms of what gets released where and how it's going to be released. We're then going to move on to the previous meeting. We're going to have a look at how the statement came out, have a look what was different in that statement, and then look how the markets responded to that. Where were the tradable opportunities on the previous statement? We're then going to look at the data. Very important, as the Fed is moving more towards data dependency, we're actually physically going to look at the data pieces that the Fed would look at and make sure that we actually understand what is happening in the data and not necessarily what the newspapers and what journalists are telling us. We're then going to have a look at the market pricing and expectations going into tomorrow, and then we're going to just go over the key focus points. So where are the tradable opportunities that could potentially move the markets aggressively tomorrow? And then part two, we'll start looking towards market structure, tradable opportunities and trade patterns.
Okay guys, so to start with, Fed in a nutshell. So the FOMC meeting is tomorrow. Well, that's not entirely true. It's actually today and tomorrow, but for our purposes, the release of everything is tomorrow. So 6 GMT to New York time, the Fed will announce the details of the latest FOMC decision. Not much is expected in terms of rate decision. Rates expected to be left unchanged. Nothing in terms of QE or tapering. That's all in the past now. The key focus for us and the Fed will be the language, particular focus on the word patience that has got a lot of traction recently from the meetings last year and early this year, and the potential dropping of it. Additionally, we will get the updated economic projections, the updated dot plot, and then we will have a Yellen press conference and Q&A at 6:30. So the format, now the FOMC meet 8 times per year, not necessarily every 6 weeks, but 8 times per year nonetheless. And not at every meeting do they update their economic projections and the dot plot, and not at every meeting do they have a Yellen press conference and a Q&A. Last time round they didn't have that, so this time round they will have it. So at 6 o'clock GMT, 6 o'clock because of the clock changes, normally it's at 7 o'clock, we'll get firstly an announcement of any change in the Fed funds rate, then announcement of any QE or tapering, the statement release, the updated economic projections, and then the updated dot plot. Now these will all come all at once at 6 p.m. So what you focus on exactly is up to you. It can be very hard to focus on everything at the same time, and it will come as essentially a screen dump, whether on Reuters, whether on Bloomberg. So you need to know what you're looking at, what you're looking out for, but these will all happen bang on 6 o'clock. If you want to go through and read the statement and actually analyze the dot plot or the economic projections, they will be available on the Fed website straight away at 6 o'clock. But for trading purposes, 6 p.m. is when all this gets released. Then we have a little bit of a lull. Market will probably move, make of it what it will, and then at 6:30, Janet Yellen will give a press conference and a Q&A. Now Yellen's stance herself has generally been slightly on the dovish to neutral side, and that it's likely that her own position will get questioned, but also more importantly the position of the board, what they believe. They'll probably have to justify or talk about some of the updates to projections, updates to the dots, and they'll be quizzed on anything new or omitted in the statement, and we'll go through that in a little while. So I'll pass on to Brannigan, who will actually just go through a little bit about what actually happened in the previous meeting.
Okay. So previous meeting, this is a bit what the statement looks like. Okay, as Imran says, it gets dumped. Now it starts off. If you want to shut the lights off, yeah, go for it and you can see it. Okay, so first up, remember, always look from bottom to top when you're looking at the statement, because what they tend to do is put the most important lines first. Okay, so first up, they said Fed repeats they can be patient in beginning to normalize stance of monetary policy. So the first thing that we effectively saw was that they dropped considerable time. Okay, we moved away from this idea of considerable time and we started on this idea of patient being 2 meetings. So we maintained that whole patient stance. The Fed then vote in favor of policy was unanimous. Very important, okay? When the Fed is not unanimous, it means that they're not all necessarily agreeing on the statement that they're putting out. Now, we don't always see a unanimous FOMC, so to see them unanimous is very good, particularly as we're getting closer and closer to interest rate liftoff. Okay. Also, if we get something important come out, in other words, tomorrow, let's say they decide that they're going to become data dependent and move that step forward, we want to make sure that they're unanimous in taking that step, because then at least we've got agreement amongst the members. The Fed said the economy is expanding at a solid pace with strong job gains and lower unemployment rates. The Fed says inflation has declined and may decline further, but should increase over the medium term as labour market improves and temporary effects of low energy prices rise. So very important to take from that. We know the Fed has told us on numerous occasions the current inflation movement in the near term is expected to stay low and go even lower. They've told us that, and that is a result of the oil. They've told us it's transitory. In other words, what's going to happen eventually is as this impact starts to move out of the CPI, in the long run, we're actually going to see it have a positive spin-off effect on medium-term inflation expectations. So very important is not the near-term inflation expectations of the Fed, but the medium-term, i.e. 2016. Okay? Then, Fed says some market-based measures of inflation compensation have declined. In other words, what they're saying there is that what the market thinks in terms of inflation going forward is very, very low. And we're going to go through a chart. I'm going to show you what it looks like. I'm going to show you what the market expectation of inflation look like, and you'll understand why the Fed's saying that. So they're acknowledging that the market's expectation of inflation is really low. They're not disputing it, they're acknowledging it. Okay? And what they're saying is, while the survey-based measures of longer-term inflation expectations have remained stable. In other words, what they're saying almost is that, in our opinion, our medium-term forecast or our outlook for inflation in the longer run is stable. So indirectly, they're not saying the market's wrong, but they are saying the market's wrong. Okay? They're saying, we think it's going back to where, the market might be pricing something else, but we think it's going back there. So eventually, that line could change. Eventually, they're either going to agree and say, well, you know what, actually, we're a little bit, we're not quite getting towards our inflation expectations. Or what they're going to keep is this one line where they say, you know what, we acknowledge that market-based expectations inflations are low, but we still think ours are correct. Okay, in which case, either the market or the Fed, one of them is going to be wrong at some point. Then, Fed says risk to labour market, economy remain nearly balanced, and Fed says Fed says labour market slack continues to diminish. Again, we're going to talk a little bit about slack when we go through the data, but they keep referencing this idea of slack keeps diminishing. And if slack diminishes, it means that wage growth is going to start to feed through, and that's going to feed to inflation, and then ultimately we're going to start to hike interest rates. Fed repeats committee continues to monitor inflation developments closely, and the Fed repeats timing of rate hikes continue to depend on incoming information. So again, data dependent. The Fed remains data dependent. Okay. The one thing that they don't state then, I think Imran kind of touched on it, is Yellen's stance. Yellen has reiterated a number of times that she wants to ensure, the Fed wants to ensure that inflation is heading back to that 2%. The minute the Fed is comfortable with the idea that inflation is going to head back to that 2% target that's when they will be confident in hiking rates. Okay. So, very briefly, I've just listed the changes there, as you can see previously. The Fed remains patient, okay, and it drops considerable time. There was a unanimous vote, economy expanding at a solid pace, strong jobs and low unemployment. Inflation decline and likely to decline further, and the inflation market-based measures. So effectively, I've just noted what were the changes from this statement to the previous statement. Then there was no Yellen conference. Okay, there will be one this time, but there was no Yellen conference, and nothing to pick up from there. In terms of the market reaction, bonds initially went offered, okay, led by the front end. So as the statement came down, we had the considerable time being dropped, which was kind of expected, but we had a very good reference to the expanding and solid pace of jobs. So that kind of gave the markets a little bit of an initial hawkish tone. So bonds sold off, led by the stirs. That then reversed. The stirs turned around and went bid, and the 5s and 10s then accelerated to the upside. So the net result of the meeting in terms of the bond space was 0. Okay, the bond yields didn't really move a great deal over the course of the meeting. In other words, what that implies is that there was nothing really new fundamentally that we could have taken from that statement. There were a few hawkish elements, a few dovish elements, but ultimately it was a balanced statement. In terms of the dollar, it was initially weak, but then strengthened. Okay, so again, same sort of thing. We saw a sell-off in the dollar, and then it rallied. Gold and oil dumped hard before bouncing. The euro and pound sold off and made new lows on the day, and the yen maintained a bit. So again, a little bit more in the dollar. We saw the dollar kind of hold on to some gains, but that was probably a little bit more of a technical play rather than a fundamental play. And then briefly the equities. Okay, they sold off quite hard, and then they knee-jerked back up, and then they sold off into the close. So watch very carefully, particularly for the equities if you're trading it. Watch the 9 o'clock close. You tend to get a sort of a very aggressive move in either up or down into the close based on whatever's happened in the FOMC. Okay, so now the crux of it. This is the important part. Okay, the Fed is now moving away from this whole idea of 2 meetings, 5 meetings, 6 meetings, considerable time, whatever it may be, and they're moving toward data dependency. So for us as traders, for us as investors, we need to ensure we know actually what's happening with this data. And what I mean is not what's happening from it month to month, I mean in terms of trend. So we need to start looking at the key data pieces in depth and understand at what point is the Fed going to actually start moving. So very briefly, the NFP came out at 295 versus 240. That was the previous meeting, a substantially better number. Okay, unemployment came down to 5.5 versus 5.6%, and wage growth was steady at 0.1 versus 0.2. So we're continuing to see this very strong trend in jobs data. Now I'm going to show you what the chart looks like, and you'll see effectively what's happening in terms of the NFP is we're just constantly seeing this steady rise higher. If you look at the purple line, ignore the spikes, but look at the purple line. Effectively, that is just the average or the yearly average of jobs being created. So you can see a very steady incline since effectively the start of 2014, just this gradual rise in jobs being created. Okay, and this is very positive. At the moment, the average is 270,000 jobs. Now, what the Fed's been continuously talking about is the erosion of slack, i.e. what that means is simple. It means back in the days, a lot of people were lost their jobs, okay? And now that everyone who wants to work is back in the workforce and they're actually getting jobs created, it means that what we're going to start to see is that there's going to be price pressure on wages. So effectively, as the supply of labor starts to decrease, i.e. the slack, what will happen is wages will start to rise. And as wages start to rise, consumers will spend more. And that'll lead to inflation down the line. Then PMI manufacturing data came out better than, slightly lower than expected, 52.9 versus 53.4, where the services data came out slightly better, 56.9. Now if you look at the PMI manufacturing, again, well above the line of contraction at 50, but again, over the last 4 or 5 months, we've started to see just a steady little decline in the manufacturing data. Important to note, however, manufacturing doesn't make up a very large portion of the US growth. Okay, very important to know. PMI is important, okay, but it's not the most important data piece for the Fed. Okay. Then, one of the single most important, core CPI. In other words, physically, what consumers are spending excluding volatile goods. Okay, we had a 0.2 versus 0.1, so there was an uptick in core CPI month on month. Let's look at the chart. Okay, effectively, that's not core CPI. Go sideways. Nope. There we go. Okay, so what I've done here on the core CPI is I've actually plotted for you the interest rate cycle of the Fed. And the reason I've done this is because so many people go wrong and they look month to month at what inflation is doing, forgetting that inflation is a lagging indicator. I.e., in other words, if you go back to 2004, somewhere around this part of the curve, you will notice, okay, what happened was as the core CPI was coming down, okay, it then bottomed out, but eventually it started to rise. Okay, and what we saw was that, where am I looking? Okay, so what we started to see was that whilst the inflation was bottoming, okay, even before we got to this red line, which is 2%, if you look there, even before we got close to 2%, the Fed started hiking cycle. Okay, so it's not so much about inflation being at 2%, it's about the Fed ensuring that inflation will get to 2% in the future. Okay, so when a lot of people come out and say there's no inflation, of course there's inflation. If you look at the moment, there is inflation. We're printing 1.6% year on year core inflation. Okay, so what the Fed wants to see is we've printed 3 lows at this 1.6 now. They want to see this steadily start to tick up. And well before we get to this 2%, the Fed would have hiked rates. But the important thing they want to ensure is that, is this going to start to sustain a down move now, or is this actually just temporary in nature and going to turn back upward? So very important, keep an eye on that chart. Then the core PCE, so the consumption expenditure of the consumer. Okay, we have a brief look at that chart. Effectively, it came out again as expected, but if you look at the chart, yeah, a little bit. Okay. Actually, no, sorry, that's retail sales. Yes, that's it. Okay, so if you look, for instance, now at the, was that inflation? What have I got there? Just, yeah, grab it on the, yeah, I think that is the PC, just grab it on there. Core PC, yeah, I think that is it. Yeah. Okay, so effectively what I've done here again is, I've just illustrated for you, if you look at that little area there, that was the time of the previous hiking cycle. Note, core PCE was hanging around 2%. Okay, so what the Fed wants to see is they want to see this uptrend continue. They don't want to see this now start to downtrend. So the minute we turn back again in terms of consumption expenditure, that's when the Fed's going to start to become a little bit more confident that inflation is starting to build up. Okay, and the last data piece, or the second last, is the US retail sales. Now, what we've heard in the newspapers the last 2 months in a row is shocking retail sales, end of the world for the US. Okay? Yes, we have seen two very, very bad prints in retail sales. The important thing to understand is that, one, retail sales is seasonally affected. Okay, we've just come out of December. In other words, consumers have got no money. They're paying off December time. Number two, we've had weather-related issues in the US. So shoppers aren't going to go out when it's snowing or when they can't get out of the house. So bear that in mind. The last two prints have been bad for very good reason. So again, the Fed's not going to just go and say, well, retail sales is bad, therefore we need to become, dovish, right? They know this and they'll take that into account. So let's look at the chart. Okay, again, we've seen some very low prints of late, and as you can see, we've seen a very sharp downtrend in the retail sales data. So again, what we want to see is we want to see that retail sales start to turn up. Don't be surprised if the April retail sales comes out much higher than expected. Now, as we get a very, very big number as consumers rush back to the stores and spend all their money. Okay, and then the last chart, again, the Fed mentions it, the inflation expectations. Okay, what is the market's expectation of inflation? If we look at it, this is the current inflation expectation. If you look, since the start of the year, effectively, we've just continued on the steady downtrend. In other words, the market does not believe there is inflation in the future. They're not seeing what the Fed is seeing at the moment. Okay, so what the Fed wants to try and do is convince the market that actually there is inflation and you need to start pricing a little bit more aggressively. What Imran's going to do after this is he's going to show you what this effectively does to the bond curves when you have low inflation expectations being priced by the market. Okay, and then I think that's all the data for the previous month. Scroll down. Yep. Okay.
All right, guys, just a little bit about what the market is pricing going into FOMC. Every time, this is the first thing we should do. Know what the market is pricing so we know whether to be surprised or not when the dots get released, when the Fed are hawkish, when they're dovish. It's always in the context of where the market is at the moment. So to start off with, the current Fed funds target rate is 0 to 25 basis points. They have a band. And the current fixing rate itself is 11 basis points. So that's where the starting point is at the moment. We are at 0 to 25 basis points. Now, when we talk about rate hikes, when the Fed talk about rate hikes, they are talking about the movement from the upper end of that band, from that 25 basis points upwards. So 25 to 50, 50 to 75, and so on and so forth. So the first rate hike, when we talk about the first rate hike, we're generally referring to when we get to 50 basis points. Now, the Fed don't have to move in 25 basis point increments, but they historically do, unless you have emergency moves, and we're not in an emergency situation. It's very much a calm US economic situation. It's not like a crisis when they cut rates, central banks cut 25, 50, 100, depending on the central bank, 150. It's not that sort of scenario. So this 99%, with 99% certainty, the first rate hike when it comes will be 25 basis points. So we are talking from 25 to 50. So the first rate hike to get to 50 basis points, as indicated by the Fed Funds 30-day futures, is priced for November 2015. So if Yellen, for whatever reasons, comes out and says first rate hike in November 2015, should the market move? Well, in theory, the STIR shouldn't move, but they probably will, because she's never said that before. And generally, the Fed speak has been kind of sometime at mid-year. But in theory, the Fed Funds futures are pricing November 2015, so it's important to know that. So if we go the current market pricing relative to the dots. Now the dots will get updated and released. The dots are essentially the median forecast from all the FOMC members of where they expect rates to be at the end of 2015, end of 2016, end of 2017. So the current market for December 2015 is pricing 0.56%. The current Fed dots are at 1.125%. So if you look at the difference, it's about what? Almost just under 60 basis points, roughly. DEC 2016 to market's pricing about 1.37%. Fed dots 2.5%. So about 1.125% difference. And the further you go across the curve, DEC 2017, 1.94% the market is pricing versus the Fed dots at 3.625. So that's, almost 170 basis points, 1.7%. So what does this tell you? There's a big differential between what the market is pricing and what the Fed dots have been implying. Now, to be honest, I'm not too fussed about DEC 16, DEC 17. Neither is the market at this stage. That can deviate all at once. But what is interesting, what the market is fixated on, is when the first rate hike will come. And that's why the December 2015 dots are what I think is important and what the market is focusing on. So I've had just as a way of comparison what the market was pricing in January, and we can see for DEC it's not too much difference. For DEC 2015 it's not too much difference. For DEC 2016 essentially you've priced in an extra rate hike the market has, and for 2017 essentially 25 basis points. The market's priced in an extra rate hike since then, but still well off what the Fed dots are implying. So by looking at this dot plot relative to market pricing, the Fed, according to their dots, are saying essentially they may raise rates 3 to 4 times this year. Now, to get to 1.125% in 25% basis point increments, that's minimum 3, maybe 4 rate hikes. Now, it's pretty much a given they're not going to do anything this meeting. So there's only, 6 meetings left in the year to do 4 rate hikes? The market doesn't quite believe that. Then again, the dots say the Fed may raise rates 5 times in 2016 to get from there to there, essentially, 1.125% to 2.5%. The market's saying 3 to 4 in terms of getting from 56 basis points to 1.37%. And then finally, in 2017, the Fed is indicating by the dots median. This is a median, so it does kind of take where's in the middle, it takes out the outliers. The Fed is essentially saying they may raise rates 4 to 5 times, but the market 2. So what we take away from this, that a market expects a later lift-off, i.e. rates to go up later than the dots imply, and also a slower hiking cycle. And for you guys who know me well by now, I like to draw pretty much everything in a yield curve sort of scenario. So if this is yield and this is time, the market curve, I don't know why the color's not working, the market curve is essentially like that, and the Fed curve is essentially a lot steeper, quicker pace, earlier starting point.
Important thing, guys, I know you're looking at this and some of you are going, oh, I don't really understand it, but what that means eventually is that either the market's wrong or the Fed's wrong. Okay, ideally as traders, we want that Fed to be 100% spot on about what they're thinking, because if that's the case and the market needs to reprice, okay, we're not talking 10-tick moves here, we're talking 5-6 point moves, and it's going to happen quick, and it's going to be fast, and it's going to be intentional, and there's going to be flow, and there's going to be panic, and it's going to be awesome. Okay, so you guys need to get excited about this. We are entering an era of potential amazingness in the bond markets. Okay?
Yeah.
What happens if it's the other way around?
Okay, again, if it's the other way around, remember that the Fed will come toward the market, not the other way around. So the Fed will effectively lower their focus. I think that's what everyone's going to talk about.
Let me just stop you. I'm going to go through that. But just before I do, just historically, what have the Fed done in hiking cycles? The last hiking cycle was in 2004 to 2006. The Fed hiked rates in 17 consecutive meetings in 25 basis point increments, from 1% to 5.25% from June 2004 to 2006. Now, the market doesn't believe they're going to do that. The market believes it's going to be extremely slow. The Fed, while it doesn't believe it's going to be as slow as the market implies, it's not going to be every single meeting. You can see this. 8 times a year we have meetings. Maybe 3 or 4 times a year, maybe 5 times they'll hike. So there are going to be pauses along the way. It may be a hiking cycle, but there are going to be pauses. Brannigan, if you could scroll down, please. Okay, so we've seen what the market's pricing. There's this big disconnect. So for me now, there are some key focus points. And the first one being the updated dot plot. Now, we mentioned about 2016, 2017. Yes, they will also get released. But for me, the key focus is 2015 because that's what everyone is interested. The dots could be revised lower across the board. But if 2015 dots are revised lower, is that a dovish Fed? Yes, in all likelihood, it is because they're calling 1.125% as median. If it goes to, say, 75 basis points, they are more dovish or less hawkish, whichever way you want to put it, than they have been before. But in terms of the market moving, the market is still pricing only a 50.55% at the end of the year. So the reaction is likely to be, in my opinion, smaller than if the Fed leave the dots unchanged, because there's a bigger discrepancy to close from 1.125% the dots to market at 55 basis points or 0.55%. So for me, this will be the big move. This will be the big move here. This you'll get a move, but the dots being unchanged are where the bigger move will happen, and that should kind of answer your question, Jet, because there's less scope for convergence if the dots are lowered by the Fed. The market is sort of expecting the dots to be lowered. So if the dots are currently over 1% and the Fed release 0.75, then it's closer to what the market is pricing. So the convergence trade is smaller. Whereas if they maintain 1.125% as their DEC 15 dots and the market's only at 55.55, there's still over 50 basis points of yield to close up there. And what else does this tell you? This is also significant, 2015, because they keep it the same. We're one step closer to that rate hike. One step closer. Now, if they keep 1.125%, remember what we said, they're not going to hike this meeting. So 4 hikes in the next 6 meetings, that's pretty hawkish. That's pretty bullish in terms of no one has talked about that. The Fed hiking 4 times this year. No one. Okay, and also we can't eliminate the risk that dots might actually go higher. And if they do, that's probably when you see huge moves, whether bonds get absolutely slammed down, maybe equities will go down, FX, dollar will be very strong, but we'll talk about those sort of things tomorrow. Okay, so that will be in the dots, 6 o'clock. Next, economic outlook. Now, at 6 o'clock, I split this up into inflation, employment, growth. Now, the Fed are an inflation targeting central bank. They have a dual mandate. They have inflation targeting and employment. Most central banks are purely inflation targeting. So these two become very important, inflation, employment. Now, for me, Brannigan went through the last statement. The statement to me this time round is not that important. Last time they didn't release updated projections, so you're actually looking for these updated projections, and the market at the moment, the analyst community is talking about is expecting inflation to be substantially lower for 2015, slightly lower for 2016, but 2017 will ultimately be the important one. The Fed always talk about medium-term inflation. Brannigan, if you could just put up that the last round of forecasts. Yeah. So over here, we had 1 point. Whether you look at PCE, whether you look at core PCE or PCE, 2017 was 1.8 to 2% inflation expectation from the Fed. Now, if that's maintained, for me, that's positive. They still believe that we're heading towards that in the medium term. If that's downgraded, then that's a worsening of their inflation outlook. So if we go back to the slide, Brannigan, this is what in the statement was said last time. Inflation is anticipated to decline further in the near term, but the committee expects inflation to rise gradually towards 2% over the medium term. To be honest, I won't even be looking at that, because that new number will tell me all I need to know. Last time round, you got to sift through the statement and find that. This becomes less important because the number will tell you that. Obviously, that the committee doesn't expect inflation to rise gradually towards that level if it's downgraded. So that's why this could come up. You could find this in the economic projections. This will come up in the statement. It probably will be questioned in the Q&A, and she'll talk about it in the press conference. So there are so many opportunities to trade on the back of inflation. But for me, the first one to look at is this. Same thing with employment again. The Fed, employment hasn't been a problem to the Fed. That's been what's been motoring along. So again, if the Fed's employment forecasts are stronger than previously or the same, then fine. We'll just that I don't even need to read the statement. Underutilization of labor resources continues to diminish. It's not important to me. It is more important. The statement is more important when we don't have these projections. That's not to say you should ignore it, but for me, my first point of call is these projections. And same with growth. We're expecting the possibility of downward revisions to growth. Fed's last statement said economic activity has been expanding at a solid pace. Again, if the growth forecasts are the same, it's still a solid pace to me. Now, Brannigan will often talk about having hawkish, dovish, neutral scenarios, and it's quite clear downgrades are dovish, upgrades, or even typically the forecast remaining the same. While neutral, they're more hawkish than the market expects. So any surprise, if inflation isn't downgraded, the market will be surprised because that's what they're pricing in.
Just understand one thing. Growth is a lagging indicator, okay? So if they downgrade growth for the Q1 of this year or for this year, okay, that's not hugely important to the market. It's all very much lagging. What you don't want to see, and the same with inflation, okay? If they downgrade 2015's inflation, that's okay. It's not the end of the world. It's expected to be low. What you don't want to see is, as Imran says, is the medium term. So make sure you know what you're looking for in terms of unemployment growth and inflation. Where is it going to surprise the market? Not necessarily near term, but further out.
And also, the market knows employment's been strong. It's been strong for a long time. Growth has been solid. And what has been preventing the Fed from even hiking rates today is inflation. So the market will be fixated on that. Now, Brannigan talked about me going through a bit of yield curve stuff, and I will do that, but I'll do that tomorrow when we talk through some trade ideas. Okay, the third important thing, the patience language. Now, that's not in the economic projections. That will first of all come in the statement, and that's, for me, the key thing to look at in the statement. Not about inflation, not about employment, not about growth, because they will be in the projections. Not about the dots, they'll all be in the projections. In the statement, you will get this key about the patience language. In the last statement, it said, Fed can be patient in beginning to normalize the stance of monetary policy. Now, Yellen has sort of indicated that patience word is going to be dropped. Patience generally meaning at least 2 meetings. Now, Yellen at Humphrey Hawkins, her testimony last month, she indicated that would essentially most likely be dropped. So what will the market be looking for? If it is dropped, it's kind of expected, but don't get fooled by it being dropped necessarily. When considerable time was dropped, it wasn't really dropped. Maybe the word patient might be in there, and the Fed might explain about why they've dropped patience. Now, the algos last time saw considerable time in the statement, was it in December, Brannigan? I think
Yeah.
it was. And they saw it was still there. It was expected to be dropped. What happened? The bonds rallied because they expected it to be dropped and it was still there. And then actually when you go through it, it's actually there. They're justifying why it's no longer considerable time. If they do that with patience, the algos might do the same thing again. They see it there, they buy the bonds, but actually they're just justifying a withdrawal of the word. So no one's really talked about that, but I think that's pretty important. But in terms of dropping the patience and replacing it, a lot of the analyst community are talking about this reasonably confident word. The Fed will hike rates if they're reasonably confident inflation will move back to 2% over the medium term. Now, again, this reasonably confident is not so significant to me because we can kind of see the Fed's medium term outlook for inflation through the economic projections. So it is important, but again, for me, it's not going to be the first point of call. But it depends how you want to look at things. If you want to look at the statement first, the projections first, but I think it's easier to see a number than react to interpret a line. And that's why I think the projections will be most important. Okay, in terms of the other forward guidance, the Fed liftoff, she'll get questioned on this about what she believes that when the first rate hike might come. That'll probably be in the Q&A, unless she says something in the press conference, which is unlikely to actually explicitly talk about liftoff. Same about pace. She might mention that in the press conference, but again, more likely in the Q&A, the pace of the rate hikes. Again, the market believes it's slower than the Fed are thinking at the moment. Now, the Fed dot plot might all get shifted lower, so then there'll be a different set of scenarios to look at, but ultimately she'll be questioned on it. Again, another thing that not many are talking about is we're at 11 basis points at the moment. Shouldn't we really get to 25 basis points first before we even think about hiking rates? Their band is 0 to 25 and they're in the middle of the band, so maybe they might mention something to do that in the press conference perhaps. Maybe she'll be questioned about it. That's something no one has really talked about, but I think is pretty important. And then finally, the emphasis on data dependency, which Brannigan touched upon. This has been Fed speak for a while, and I think it will continue to go on. But again, if she talks about that, it does make every single data point that bit more important going forward. And when you're trading, the economic data, be at your desks, every data point will be important. And when in the Q&A, she'll probably be asked, what is the most important? What are we looking out for? The market ultimately wants to know when the first rate hike is going to come, not if, but when. Okay, and finally, global outlook. This could, again, come in the statement, the press conference, or the Q&A. And it's important to note that the US economy is the exception as opposed to the norm. Maybe the US and potentially the UK, because their next moves are going to be up. They're thinking about hiking cycles, tighter monetary policy. Now, ECB have started QE, the RBA have cut rates, India have cut rates, China have cut rates, Korea just last week have cut rates, RBNZ have shifted from hawkish to neutral, Bank of Canada have cut rates a couple of months ago. US is the exception. So will the Fed acknowledge that? Will they acknowledge the other rate hike cuts elsewhere as being stimulus for them? That's another thing to look at. That might be, again, in the press conference or the Q&A. Oil prices, I'm not going to really touch on that too much. Fed have continually said that low oil, short-term effect, downward inflation, long-term effect, positive growth. Now, if there's any deviation from that, that presents an opportunity, but I don't think there will be. And finally, dollar strength. Now, while oil has a short-term impact, low oil prices, a strong dollar does not have a short-term impact. That influences their terms of trade, potentially inflation numbers, potentially growth numbers. A strong dollar is going to be a drag. Fed, I think there were minutes maybe 6 months ago that they kind of had a very slight mention, but it's never been important enough to come up in a statement or for her to elaborate on it in a Q&A. But it will start to be a concern. The dollar's gone up and up and up in the last 6 months. It's going to worsen their terms of trade. It's going to hurt exporters. It's going to ultimately be a significant pass-through on inflation. Oil might be a short-term effect. The dollar will not be a short-term effect. That will feel the hit now and continue. So again, that for me is what could prevent the Fed from hiking rates sooner rather than later, and that could be a real dovish slant that not too many have talked about. I'll pass on to Brannigan. I think he wants to add one or two things to the key things to look out for.
Okay, well, just very briefly, I think this chart, if you want to quickly show that, I think this chart's awesome to look at. Okay, what you've got here, effectively, is it's just the hiking cycles of basically the G6 countries over the course of the last couple of years. Now, the one I want you to look at predominantly is that big, thick pink line. Okay, effectively, if you look since the 1980s, all we've done in terms of interest rates is we've just literally gone lower and lower and lower and lower. But then suddenly, in the last, since 2008, for 6-7 years, we've been at rock bottom, 0. Okay, so what you as traders have to ask yourself is, at the end of the day, whilst we've come to this 0 point, normal rates are nowhere near 0. Okay, and that's where I think a lot of people are going wrong at the end of the day. Is you've got to remember is that the Fed's not necessarily hiking rates to slow down inflation. They're hiking rates because they realize that we're at an area we've never been before. This is in history, we've never been this low. And you can see all the lines are effectively getting near that low. Okay. The other important thing I want to point out is the cycles. Note, just because the Fed is going to be the first to hike, it doesn't mean that the rest of the world won't eventually follow suit. Okay. There has been times, and you can see it if you go and look at it, there has been times where effectively, for instance, the Fed has started hiking whilst other central banks have, Fed started hiking and other central banks have been cutting. Oh, Fed's been cutting and other central banks have been hiking. Okay, you can get these divergences. It's not a huge issue. All you're reading at the moment in the FT and the Wall Street Journal is how when the Fed starts to hike, it's going to be a crisis across the world. It won't be. Okay, the Fed needs to start hiking, otherwise they're going to experience some hyperinflation and it's not going to be good in the long run. Okay, so that's what I just wanted to show you from that chart. And very briefly, the last little bit of thing to think about is for your preparation for tomorrow, okay? Get your list of your outlier trade opportunities. Those are the opportunities that the market is not priced for. As traders, you have to have 2 or 3 scenarios in your head where you go gun-ho, where you go balls to the wall and you go as aggressively as you can. But you need to, as traders, prepare those now in your head. What are those situations, i.e., like Imran said, if the Fed maintains their medium-term interest rate expectation for 1.12% for the end of this year, that is as hawkish as you are ever going to get. But you as traders need to know how are you going to respond in that situation? How aggressively are you going to hit? How far do you think it'll move? You plan that now and you will have a golden opportunity, maybe not tomorrow, but at some point when the FOMC does give us an outlier. So very briefly, I've just written down some outliers I thought of. Okay, the first one was if they downgrade their medium-term inflation forecasts. Very dovish. Okay, they're going to bring themselves a lot closer to what the market expects. But that means that we've got a very strong dollar at the moment that's pricing in very aggressively, and we could see a very big move in the dollar space. Then, if the Fed replaces its patience with data dependent, there's a lot of people that are expecting this, but the market's not fully priced for this. Right? So you're going to get a pretty aggressive fast money move when they change from patient to data dependent. And then if they talk about slack being more than expected, okay, a couple of policy people have been saying that at the end of the day, the only reason we're not seeing wage growth is because we're starting to see more people come back into the workspace, i.e. there's more slack than the Fed expects, and that's why we're not getting inflation. Then the impact of a strong dollar. So if Yellen were to verbally say, while she's not allowed to and while she probably won't, if she were to hint at the dollar being a concern, okay, again, you're going to see some fast money moves off that. Okay, so in a nutshell, guys, very briefly, for tomorrow, have your outlier trade scenarios, have your trade plan. More importantly, once you've got these outliers, just want to scroll down, make sure that you list them in terms of get your structure of your charts. Make sure you know exactly what sort of trade patterns you're going to be looking to trade, and then what sort of money management tools you're going to use. How you're going to enter, how you're going to exit, what size you're going to use, what stock management you're going to use. Okay, very briefly, for tomorrow's part 2, we're going to go over market structure. We're going to deal with the bond market, starting with the stirs and going up the curve, 2s, 5s, 10s, 30s. We're then going to move to the dollar, have a look what the dollar's done, have a look where the opportunities are going to be in the dollar space, and then have a look at oil and gold as well as the equity markets. We'll then talk about 3 market pattern plays. I'm going to draw them for you, I'm going to illustrate them for you. I might even show you an example or two. And then last but not least, we're going to go through a few trade plans. Okay,
Okay, guys. Yep, Brannigan's wrapped that up beautifully. Today we've very much talked to you. Tomorrow, you come with your plans as well. We'll share ours. You can share yours, and we'll go through it. Brannigan often talks about hawkish, dovish, neutral, his scenarios. That's essentially what you should do as well as part of your planning. What will the market take as hawkish? What will the market take as dovish? What will the market not really care about? You know, it doesn't matter if you take it as hawkish, dovish, or neutral. It's what the market thinks. And, you know, having that sort of format in the context of these market structures, in the context of what you're going to trade, will ultimately be fantastic planning that not everyone does. It's those who plan, you know, everyone can have a view, but if you plan, have your levels, have your charts, have everything ready, you'll be the quickest to execute and be able to maximize your P&L. Sure, you may be able to get lucky and make a bit of money without planning as maybe you should, but you won't be able to have your best ever day if Yellen drops a bombshell, that's for sure, because you won't know where support is, resistance is, where you should be getting out, what the market's pricing, how far things can go. You need to do your scenario analysis in advance for these outlier trades. These outlier trades are the ones that you can make your career on. The market may think, oh, this is not going to happen, so they might ignore it. You could think this is not going to happen, but just in case it does, I want to be ready.
Cool. Have a good afternoon, guys.
Cheers.